Hey everybody, welcome back to Trading Index Options. My name is Mike Fairborn. Good to be sitting in for Ben Watson, who, yes, I was just seeing in the chat. I believe he is out traveling right now. In fact, I'm pretty sure of it. Yeah, so it may be to Houston. So, yeah, if you're out in that neck of the woods, you might spot Ben out there. But good to be with you all, folks, today. Hey, we're going to take a look at the general market. Also, in looking at some of the index options that are out there right now, there could be some potential signs or indications of potential strength in terms of using both short put verticals or an iron condor. Today, I want to take a look at doing both over a set time frame and set strikes that might make sense to what Ben's been discussing in this class specifically. But of course, we'll go through that in more detail here just momentarily. I'd like to welcome you all here on board. I do recognize, even though this is not a class I normally teach and first time teaching it, just want to state that yeah, there are some names here: Jay Richardson, Greg, JD, and others in here. Welcome to all you guys. Any questions or comments you have, definitely throw those in the chat. I have a very good friend on board with us today, Mr. Cameron May, who has actually let me go fishing out at his nice estate. It's a nice place to fish out there, so I appreciate. Always remember that one, Cam. But good to have Cam on board, very knowledgeable on the topic. And folks, today we're going to take a look at the markets. We're going to look at the VIX as well. How does the VIX play a role in the market, specifically as it relates to index options? So looking forward to that. By the way, let's go ahead and take a look at some disclosures before we jump on into things here. Information here is for general information purposes only. Investing involves risk, including the loss of principal. Past performance is no guarantee of future results, and dividends are not guaranteed. Don't think we're going to be talking about any dividends today, but it was on that line, so I read it there. Index equity and index options carry a high level of risk, folks. They're not suitable for all investors. Now, American-style short options can be assigned at any time up to expiration, regardless of the in-the-money amount, right? When trading options at or near expiration, you must consider the risk specific to such strategy, including liquidity, significant price slippage, and volatility. Now, probability analysis results are theoretical in nature, not guaranteed. Final slide. There's no guarantee that the execution of a stop order will be at or near the stop price. Paper money software application is also for educational purposes only. And having said that, let's go ahead and fire up the desktop and get rolling here. All right. Well, very good. Let's go ahead and take a look here at our S&P 500. There you go. There's the S&P right there. How are we doing today? Got an hour left, a little bit more than an hour left in the day. You can see if I just zoom in on that S&P 500 right there. Well, it is interesting. We've rallied up pretty sharply off of these lows, and you have to say that just looking big picture, and this is oftentimes sort of an indication that traders can look at when you're exploring the trend. It took us a little while to get down here, but it didn't take us nearly as long to get back up here. From that point in time, we really just went a little bit flat here. And so what I've been saying, I'll say it again, pardon me for you guys that have heard me say this in my other classes, but it is interesting at this time of year to maybe be seeing a bit of a sort of flag pattern coming in over here. This is just a X post that I sent out where it just says position for a year-end rally. There's the short-term flag projection, if in fact that's the case. Now, this was a couple of days ago. We've since kind of approached the top end of that range, actually. And so, is there a potential target? The target I had listed based on this flag from this low to this high puts it about 71.30 range. Okay. So park that in your mind as you look at this. By the way, be sure and follow Cam and I on X. Cam's got some great stuff on there. Cameron May CS, Mike Fairborn CS. If you want to take a look at this, it's right there on my X handle as well. Definitely, folks, consider giving us a follow if you do like financial related content, stuff that we do see. If we're not teaching a class and we see something, sometimes, hey, we'll send a post out, put some eyes on it, and just see what's going on out there. So anyways, this is where we're at right now, and I think the market's trading right at its high of the day. A quick way to take a look at that, just go in on a short-term basis, 5-day, 5-minute. We're darn close. We're right up in that range, and that's the 5-minute bump right there in price, right? All right, I'm going to go ahead and take a look at this in just a second. Let me go over here and we'll pull this up and just pull it over here again. Take a look at it. I have this set up as a daily, a 30-minute, and a 5, so I can just go through pretty quickly, see what my 30 minutes doing, see what my 5. I really want to just show you the 30-minute chart and show you where we're at right now. Now, what is interesting is we did have a pretty sharp rally right here, but we are right back to this prior high. And if you look at it, we're right back to this kind of general range over here as well, too, right? There was a prior high here, too. So that's kind of what we're facing. It's a good, strong rally. Will it be enough? We might end up knowing tomorrow on something like this. Because a lot of times what traders will do is they'll say, yeah, maybe I'm closing above my range or getting close to it. But am I getting that one follow-through bar that does what? It gets us through all these potential additional entanglements up here where, where there's some trades being placed, prices were coming off that level. The markets were rejecting those highs and it was coming down through here. Will we take that out with one more day? Now that additional move in the minds of a lot of traders could go a long way in sort of that end of the year rally. There's the end of the year right there. We've made it all the way to the end of the year. There is our grid. That's one of the grid lines I'll let stay on there. And that's the year-end mark. Very helpful, very useful to see. Quick note too, I did this in the class earlier, but just in case you haven't seen it, under style, once you're already in charts, click on style, go down to chart mode, click on down to seasonality, and you'll see what on average the S&P 500 will do over whatever given time frame we're looking at. In this case, 5 years. We can look at 10. I want to look at 20 because a lot could be said if we run to the end of the year. A short put vertical here on the S&P 500 index options could be interesting. All right, and so let's do this. I'm going to go ahead and just make this comparable. Clicked on the wheel. Going to go over here to our price axis so we can see this because the data down here, folks, it happened a long time ago. What happened, some of it 5 years ago. So it's at lower prices. But if we click this, it makes it comparable by percentages. Now, normally November is high and we tend to kind of drift up towards the end of the year. We had a dip in November. So could there be a catch-up phase, catching up to where, prices would have gone had we not had that dip in November? That's the question. Okay. Watch this. That's our 5 year. You think it changes a lot on the 10? We average in 10 years? Not really. November's still generally known, historically, going back at least 50 years or so, a lot of, analysts will say, is like the strongest month of the year. Let's hit it again. Oops, right here. Go to a 20. Let's see, that's a 10-year daily. Let's go to a 20-year daily right now. And there you go. Big month in November, still the rally up higher. It's still kind of a drift, right? Might be a little bit sideways, but it's drifting nonetheless. So we'll see if this little pullback in November, which has traditionally and historically been one of the strongest months of the year, if not the strongest by a lot of analysts, what they'll say over the last, several decades. But can that be a reflection into a bounce back over here with just the normal drift, but maybe a little bit more strength? We're seeing a bit of a bull flag formation, as I showed you guys with that tweet, but let's just see how it does unfold right here. And let's just see what happens one day out. Now, the one thing we can do as we are looking at this, and I'll quickly click back on my wheel and go back to the price axis and just flip this back to regular prices as opposed to percentages. But one of the interesting things is, and we'll get into this in just a second, we still need to look at the VIX, but keep in mind, if prices were to go up, somebody that might be buying the ETF for the S&P 500, well, if they're buying it, or other stocks within the S&P 500 in the market, folks, it can go one direction. It has to go, you got to buy low and you got to sell high in order to be profitable. But if we're down here, I'm just going to point at some levels, whatever these might represent on a delta basis. But if we're down here, we're right on this line. We're selling a put down here at this range. Well, in order to be profitable, traders will try to or generate income, off this. Prices can go up, of course, as much as they want. They go sideways. They can also go down. Traders will anticipate, if it can hold above that strike price, making the max gain 3 directions. It's not too bad. That's one of the benefits. And that's if we just really weren't sure what would happen. But because we're still kind of at resistance, some traders might say, yeah, well, I think even if we were to bounce around a little, we come back in here, we just kind of drift up and over here. Oh, end of the year. It's kind of a race against time, isn't it? What's going to happen? That's one scenario. It could dip down like this. That could be another scenario. Of course, it could just break out. Another scenario. But time could be limited the way that we're going to look at it today. We're going to keep our time a little bit tighter, maybe going out 8 to 10 days or so here on this option. I did look on Ben's previous classes, and he did the 0 DTE quite a bit, but we'll be going out a little bit further for this SPV, this short put vertical. Okay, before we dive into that, and before we dive into our iron condor as well, I want to do this. Let's look at the VIX right here. Look at the VIX. The volatility index, the S&P 500, we've come up here and we've touched this level a few times or very close to it. It's really above 25 and roughly below 30, where we've hit in this general range. When we reach these points, it's not unusual for the VIX to go down and to consolidate for a period of time. And that's exactly what we've been seeing right here with that VIX. The VIX has been, clearly heading lower. And with that, markets are able to kind of gain some traction and go a little bit higher. Okay. Now I realize we're getting towards the lower end of our range, but look how long, if you just look at a time frame, particularly, and by the way, here's another one right there that we hit. Prices can come down. They can also spike sometimes, but when you get into that low drift that gets down here into this range, a lot of times it might just be maybe some bounces here and there. But generally speaking, if you keep coming back down to that 15 or thereabouts, or even a little bit lower, if we were to go back on a 2-year chart, can drift a little bit lower. It can hug that line for a while. And if that's the case, well, the VIX and the SPX are inversely correlated, right? VIX down, market up. I'm just saying there's a bit of a tendency for that VIX to come down after it's coming off of these higher levels to drift down a little bit. I'd say this was kind of the unusual one that we saw right there. That was unusual. For November particularly, we just don't seem to get that in November. But we're back down here kind of towards the year-end rally. So a couple of things might suggest that we could continue to drift or at least stay sideways, which could build the case in the minds of some traders for a short put vertical on SPX. An SPV on SPX. So let's look at those numbers right now and just see where we stand on this. I'm going to shoot on over here. Now, generally, traders might be looking for a range. Oh, that took a little bit. Okay, might be looking for a range of time. By the way, there is our monthly. This is likely to have maybe some more open interest, and these are all in the thousands. So no issues there. Thousands and tens of thousands for whatever we're looking at. But depending upon how far we go down, these deltas that we talk about in our manuals here, 0.20 to 0.4, are often an area where traders will try to sell option contracts. They can. And by the way, a quick note on the delta itself. A delta is measured based on a $1 increase in the underlying, and in that case, we're looking at an underlying right here. So a $1 increase, the option be impacted by the amount of the delta. In this case, if we were to go up $1, what happens to our VIX over here? Excuse me, our puts over here. Well, they had negative signs, right? Which is exactly what we'd expect with on the put side there. So they go down, and that's a positive for us as we try to collect the premium as it gets reduced because we're selling it by and large. Okay, so I'm going to we're going to shoot this out even further. So even though we've only got 8 days left expiration. We are going out a little bit further now. This is the 19th of December. Okay, so December 19th, what we're looking at. It's not quite to the end of the year, so we're even cutting the time frame a little bit shorter. We can do some comparisons here, though, on that. But if you come over here and look at this with me, gosh, hang on. Let's see. I want to go out a little bit further even, because look at the deltas. We're still kind of in this range. Interesting. Let's do this. 75, 1770. Let's do this. You guys, one thing we could do over here, although we might not have a lot of support, there is some support right through there at a prior high. Do you see that? 1650 to kind of help us get some additional context on that too. Where might there be support levels? Well, I'm throwing out the Fibonacci level right now, and if I'm just using this prior high, which was right there, see that 38.2? The 38.2 is right at that point. So we're just looking at some areas that could be potential candidates for selling puts right there. 1650 could be a number. Also, the next level is the 23.6. Okay, back to our trade on this. Actually, when I was looking at this earlier, the 1650 was about a 20 delta. It's already down to about an 18 now. I got to go back this out. So I'll tell you what, we might just shoot for the 20. Let's see, the 16, just maybe 52, 1660, just maybe above that 32, just slightly, the 32.8. I was going to try to stick within that delta range, at least of where we're selling. And you've got this one right here. All right, the 1665 or the 1670 level. If I click, we'll just go 6765, not 16, 6765. I click on the bid, and I just want to explore this first. So just a short put by itself, comparatively speaking, what are we looking at here? Wow, massive amounts of a requirement here in terms of the margin requirement, almost $125,000. Now there's your credit, and that's over 8 days. That's the max credit, right? Well, the max gain you could get at expiration, obviously. But that right there is the credit, and this is massive too. So it just goes to show that we haven't really defined our risk except all the way down to 674,000 and change. So that's obviously if the index were to go to zero. Very unlikely, obviously, that was going to happen in the next 8 days for that to occur on the S&P 500, but it just gives you a sense that there could be some room for prices to dip. Doesn't need to be that low. It could still dip. Let's go ahead and just add in now 5 wide here. I'm going to click right here on my 6760. So that gives us a 70-cent credit, 85-cent credit. But what does that do for us over here? Well, buying power effect, margin requirement dropped substantially, and so too did our max loss. Okay, that's our return right there. But remember, you say, gosh, that's not really a ton, relatively speaking, to the max loss, right? In fact, what are we looking at here? Let's pull it up right now. Here we go. 70 divided by the 430. It's about 16. But if you say a 16% kind of return on that, if we were looking at the, the best case scenario here, it's only over 8 days though, right? We're almost done with today as well. That does include the weekends where there is time decay. So that is a component that could be factored in here. Yeah. Okay. So, yeah, this is just I'm just choosing the monthly here. Yeah, good point. Good questions. Let me just minimize that and we'll hit back at it. So this is our monthly contracts, just the standard monthly, but I can compare. The implied volatility just increased a little bit right here from these prior levels, but yeah, the AM as opposed to the weekly afternoon. Yeah, I was just actually looking at the morning. We can choose that. Want to look at the afternoon? Let's do that one with the same 8 days left. So a good comment, good questions, good points in the chat. It was the 67.65 versus the 67.60. What are we getting on that one? Let me just clear this guy out. 85-cent credit for the afternoon. It's a little bit longer out, but I'm happy to put that one on. It's just morning versus the day, versus the end of the day. And maybe that's where we should stick. But notice over here, the open interest is not nearly as high as we saw on the AM. And that's what you'll generally get, just like with the standard monthly contract. Do you see those comparatively speaking? They were in the thousands and tens of thousands over here. But we could get a fill either way, just depending. This does give us a little bit more. You guys, I'll tell you what, with paper money, I am flexible. We could do it. Oh, that's only 60 though. Huh. What is going on? That just flipped really quick. Okay. You guys haven't, I take it in this class, we haven't looked at maybe too many of the standard monthly contracts that are really ending. I mean, it says the 19th. Yeah. So let's just see. Still stuck on our 70 here. So either way. Oh, yeah, it just says right there. That's the AM. It'll list it. Yeah, so you know what I was using? It's another term for the probability, is using the delta. So this is what some traders will do, is they'll use this as an expectation of the chances of the SPX going below this level by expiration. I'll pull up the probability as well just to see it. But this is just a quick read on that. Since this is the option we'd be looking at selling right there, right at the 20 delta, for example, just as an example, just above the 38.2 Fibonacci retracement level. Some will say, yeah, my expectation is 20% chance that we'll go below there in the next 8 days, right? But if we put up probability, I can actually add that in over here too. In fact, I can add it to our existing list to do a side-by-side comparison. Customize right here. When I do that, I can type in probability of touching. We could use in the money, let's see where this one stands. In fact, we'll do a couple. Okay. Probability of, oh, see, this is not, probability of touching is higher, but probability of being in the money. Notice how close this is to the delta. And that's why some traders will use that right there. It just gives us a few different, a decimal point there to go on. Very, very close to 20. But that might be just something you can kind of consider. It's a quick way to do it. By the way, probability of touching is much higher. Touching that level, not necessarily closing below it, but at least touching it. So there you go. All right. I'll leave this one on so we can just see that as a reference too. Get more familiar with it. I'll leave the ITM in there, being in the money like that. Okay. So there we go. I'll go ahead and just set this up. You guys can maybe have some consideration on variations. Now that just dipped again. There we go. 75. All right. I'll go ahead and put this, always check up top here. In fact, what I'll do is I'll just edit this. We'll do a couple contracts here. It's going to 7. Oh, it's going all over the place. Let's shoot for, I just saw it hit 80. It was also at 85. I'm going to shoot for 80 and go right there. So it's actually 160 would be the credit. A little bit of a variation. We added 2 contracts, but always, go through that confirmation dialog box and check that out. All right. So there it is. We've got it in place right there. Yes, I am in the AM. I did the AM. We can do, I did select that one. We've got a lot more open interest on that. This one actually is in the tens of thousands here. You guys do not prefer that, perhaps? For the longest time when there was index options, this is what I was, using while we were the monthlies, right? But it can be just a preference. Now, let's do this. We'll use some weeklies on the rut. How about that? So I want to go over here and show you the Russell. And I want to look at a couple of different possibilities here. Now, interesting, the Russell did take off as well. It broke above its range, and it's actually, showing some strength too out of its base. The Russell has lagged a little bit, but as of late, it's been actually quite strong. I do want to take a look actually. Well, let's do this. I want to look at the Russell as well as the others here. It was actually flat into a range, and I was looking at the possibility of doing an iron condor. In other words, selling the lower and buying the higher. And this would be calls, minus C plus C, or down below, right down through here, just the opposite, minus P plus P. Short a put, long a put that's lower. By the way, that's a great way to just to figure out an iron condor. The ones that are closest are going to be your short legs, call up top, put down below, and of course, the outer legs, call and put, these are going to be the ones that you're long. Okay, so looking at that, before I do that though, before we look any further at that, $ DJI. Oh, okay, let's see. Oh, what do we have here? We've got the indices. It's just $DJI. See, it's showing it right there. So we don't have them. Okay, DJX. No, that's on the that might be it. Yes, it is. Okay. So the Dow Jones as well. We can look. I want to look at the Dow and highlight a couple of different things on the Dow. Now we only have the weekly here, and then we've got, and that's an AM as well. We do have the AM over here too. Let's just see how that Dow is looking. Okay, now the Dow itself could be approaching right at maybe a little bit even more resistance. You got a high point here, point, point, and point. Some resistance could be up top. Well, depending upon what happens tomorrow, we could look and just see what might unfold with an iron condor. But we need to kind of just select. Now, one of the things, the Russell can and oftentimes will lead the way higher. If prices are going up or down. And the Russell, as you can see, breaking up, SPX, not yet. And of course, we have the NDX, the NASDAQ 100, which is below its high here. So I think it appears maybe a couple of the weakest ones would be the NASDAQ. It would be the Dow Jones as well, DJX. But we can look over here and just see what we've got as well. So basically, we're kind of determining here. We're going to get a sideways range, similar highs and similar lows to fit in this range for the iron condor. Okay. This is on the NASDAQ though. So let's go ahead and take a look. We'll use the weekly in this case. The weekly's 8 days out in time. Now we've got a lot in here. I think we probably only need 50 strikes. I'm going to come down here, actually zoom all the way back up, and there you go to your 20s. So that's kind of like the lower end of the range, but let's just see where support might reside. The 25,200 right there. Okay, so if I'm coming over here, wow, that still looks quite tight to me, doesn't it? I mean, look at this range right there. 25.2. We've held up above that level for about 7 days, it looks like. 8, 9, maybe 9 days if you count to here. We've held up above this range, and we could be on the verge of coming up above there, right, and breaking out. What we're going to do, let's do a leg-in strategy. So this is going to be broken up into two different parts. So we'll be looking at the possibility of the NASDAQ staying strong, the NASDAQ 100. Within the NASDAQ, of course, we have some of the Mag 7s that have looked pretty interesting, some bull flags out there that might help us lift us towards year end. Case in point, Apple, there's your flag. Google, flag. big movers potentially in the market, market weighted. Uh, Amazon bouncing. You can see the little flag projection over here as well. Is that enough to lift the NASDAQ NDX? So I think it might be too early to sell the call side, but we can do a leg in covered call. In other words, if prices continue to break up higher here, could be just fine for our short puts, short put vertical. But if we start to sort of drag or come down a little bit, let's say we come down and we start to break below these lows, then we could maybe consider putting on the short call vertical up on top, creating the iron condor. Okay, so we'd have the short call vertical up top, the short put vertical down below. And if we get both of those in, we'll start off with this one, like today, for example. We have to wait for tomorrow what unfolds the next days. But if we can get this, if that unfolds and it does come down a little, we put the short call vertical on, then we've got actually the iron condor that we've created here, right? With these index options. The interesting thing about the iron condor that you have to remember is that it can only expire. Preferably it holds within a range, right? It holds here on the short legs, short put, short call. But even if it were to go above one of these levels, it can't simultaneously at expiration also expire down here. So one side could be losing, but the other side could be gaining to offset it. Preferably, it happens somewhere in the middle here, and both of these are pluses, okay? But I don't know if we're getting enough indications. I really wanted to go through that with you today, but the Russell shot up. So that theory, that trade went out the window. But let's take a look at this. So here is our, well, actually, if I pull it up like this, you can see it a little bit better. So there's the prior high right here. That is 25,200. Okay, so it looked a little scrunched up previously, but that's kind of the range. So let's just see. I think that's where the we had the 20 delta. I'll double check that though in a second. Do we have another Fibonacci level that might line up at that point? Very close. Very, very close. Closer to maybe 25,000 right there. You're getting the 32, but we are getting some potential support levels in here. So the whole idea here is can prices hold up and keep us above that range, right? Keep us above the range of our short strike leg, up, sideways, or even down to a degree to try to collect our max gain, starting off with the short put vertical. But we'll keep the short call vertical on the upside. We'll keep it out for now, a possible leg in, but we'll just consider it a possibility for this trade if one wanted to add to it. So just kind of getting you thinking about things. If you ever see like a kablode happen, prices closing below the low of the high bar, maybe that's where somebody also legs into the short call vertical. Okay, let's hit this one and we'll be all set here. But 25 and 25,200. Yeah, see, it's like right on the verge of the 20. There's only, like we said, 8 days left for this weekly. Let's see what we're getting on this. I don't have a lot of open interest, but I'm going to click on it anyhow. And obviously the price is going to be massive, margin requirement, if it's just a short put. But if we go down and sell right here, what does this look like? It's still, okay, it's a $14 credit. What does this look like in terms of our margin requirement? A little bit higher here, clearly, with the wider legs. So we've got 10 wides over here, don't we? Was it 10? I think it was 10 wides that we saw. I've covered it up. Let's see. No, I apologize. Those are 100 wide. Those are 100 wide. So our max loss shoots way, way up on this. Was that the same we got over here on our, no, see, we're getting a lot more strikes on our standard monthly contract. I think we should probably stick with that. right at the 20 VIX as well, right here. 25,200, there we go. Let's look at the differences here. I'm going to clear this one out and we'll click right here. So what are we looking at here? So we're looking at 25 wides as opposed to 100 wides. So the credit's less, of course, that'd be the case. Oh, look at that. And what I'm going to do is go over here and let's take a look at it. So yeah, a lot less. In fact, from 8,000 and change to about 2,000, 2,100. There's our credit right there to put on the short put vertical. And that too represents our max loss, the same as our margin requirement. Now, without having said all that, let's just get a sense of what return could be compared to the max loss. So what we're looking at here, so we've got 385. I'm just going to divide that by, give us a ratio here of the 21. We'll go all the way down to 15. There we go. So this is a little bit higher than we were looking on the SPX. It's about 18%, but still over that same, folks, that same 8-day time frame. So as a comparison, it is a little bit better, but it's very comparable, you'd have to say. That's the setup, the scenario right there. The one thing I will say, though, is, yeah, because we are getting more relative to the margin requirement, I mean, it's just, we're getting a higher credit, but the margin requirement is also higher. So that was different from the SPX, right? For sure. Didn't quite get that credit amount. I went ahead and put that on. So we've got the short put vertical under our belt there. Hey guys, this is the interesting thing is when you're looking at managing these positions, you can always kind of step back and say, well, what happens next with the price? Is the price, is it bouncing around? Is it coming down? Is it giving me any further indications that I could put on that iron condor based upon price activity? You might be looking at a lot of different things within the market. It could be news related. I did see in the chat there was a note there on the chairman speaking. So that could be interesting too. That could play a role. But the nice thing is it's just over an 8-day time frame. So it's kind of a race to the finish, right? On one side, it's price action. On the other side, it's theta eating away at it. And we're just trying to keep it, staying away from those levels. It's been up for a period of time, but if it comes down, yeah, the IC, of course, creating that could provide additional premium. Of course, there's additional risk too. We break up higher, go into that short call vertical, well, there could be a loss associated with that. But you won't have them both at the same time. If it's up too high or down too high and you're above the short ranges that you've sold, can only expire on one of those at a given time. So one side of the iron condor will collect, the other one will not collect, it'll decrease. But goal is to keep it somewhere in the middle. Folks, first time teaching this class, but it is a lot of fun. There's a lot you can dive into here on options. One of the key things that I think is so interesting, I'll leave you with this, is that, the S&P 500, the NASDAQ too, the NASDAQ is a little bit more specialized, right? It's really tied into this right here. Where are you? NASDAQ 100, technology. Technology can really move together a lot at the same time. But if you go to the S&P 500, there's a large basket. Consumer staples is in here, energy, materials. What's fascinating about selling options, I think, on the, let's get to it. Just looking at the S&P 500 is the fact that there are 500 companies. And what do you think these 500 companies are doing? A lot of them are going up, some are going sideways, and a number of them are going down. In other words, it can be very, very hard for prices to move fast frequently. Every once in a while, you're going to see a bigger move. I'm going to just try to highlight a couple of these. There's a big move right there, and there's a big move right there. Now, I'm going all the way back. Let's say starting at April here, where there were some big moves. But look over here with me. Folks, it has been by and large a reflection of that VIX. You hit a level, and you just kind of drag, right? It's very difficult to get everything going in the same direction when you've got 500 companies. What does that mean? it makes it harder to go directionally over a short period of time. And that is exactly what we want to see when we're selling options. We like the slow movers where that time decay can just ease on by, right? Different, totally different from a stock. Stock reacts to individual news. You can have crazy news in the S&P. One side good, one side bad, and the S&P 500 does nothing. It stays flat. So I'm just saying it takes a lot to move it, particularly when you get in these little meandering ranges. And like we said, towards the end of the year, it might just drift up. So an SPV is an area where trader might say, I like the slowness of it, and I'm just trying to make the time decay because we're spreading it out across 500 companies. I want to throw that in at the end for you guys just to give you a general feel. So I think there can't be a lot of potential here, but you got to have a good feel for where you're at. Maybe the trend's on your side, maybe there's a price pattern, maybe, we're back up above or we're bouncing off a longer term moving average that is one that a lot of traders might look at. Say, for example, the 50 period. I'll just pull it up right here so you can see it. There's your 50. Okay, we're above it. We went below, but we're back up above it, and some would say positive at that point. All right, everybody. Well, that was great. Thanks so much. Any questions, comments you have, put those into the chat for us. Oh, you've already done that? Thank you so much. I think we covered them all, but appreciate Cam's help in the chat. And yeah, be sure to give us a follow on X, Mike Fairborn CS, Cameron May CS, folks. If you like that short-term time frame as well, one interesting thing I'll just note to you that I do teach this class over here too. Actually, I teach this class on ThinkScript, and last week we talked about this got posted a little bit late, but we did have the bull and the bear flag pattern. So this is a bear flag with a kablode, and then we had the bull flag with a kahold. These are price patterns. If you like to check those out, those scripts are located down below in the more section. Of course, ThinkScripts aren't guaranteed for timeliness or accuracy. And lastly, I'll just highlight this. Come in here. Love to have you follow us on Trader Talks. Be sure to like this presentation if you got some value out of it. And then specifically, swing trading the mags was one area that I looked at just recently because they might play a key role for prices moving higher towards the end of the year. That'd be the mags. They're so heavily market weighted, right? So let me just do this. I'll just put this in here. If you're interested, and some of you have already seen this, but there you go. Those are some rules that I do discuss as we look at swing trading, which can be helpful. This would basically be a swing trade on the S&P 500 to the end of the year if it were to follow through with that flag pattern. So having said all that, everybody, been good being with you. Expect Ben to be back next week, but have a fantastic day. Thank you, Kim. See you.